Without risk, there is no reward. In this video, we're going to look at 3 stocks and assess their risk to reward ratio when we sell their covered calls and we sell cash secured puts for them. Here we go. Let's dive in. The first stock we're going to check out is TSLL. This is actually an ETF that double leverages Tesla and the direction it moves. Unlike a lot of ETFs, it's even riskier because it only focuses on one stock and doesn't lay out its base for many stocks. So if Tesla goes down, this will go down twice as much since it's double leveraged. But let's look at the options and the premiums you can receive by selling options on this. So you do receive quite a large premium for the risk that you're taking. If you were to pick up 100 shares at $21.29 a piece, you could sell them. You could sell a covered call with a strike price of $21.50 for $79, which is a pretty large premium for the amount of money you would have invested. And this is a weekly covered call, so you could do this every week. If you go up and you wanna sell at a higher strike price, where you would make more money when the stock is sold, but you wouldn't quite make as much premium, you can see all the way up to, for instance, like $23 strike price. You would still receive a decent premium for the amount you have invested in the short time of just 1 week. Let's also look at the cash secured puts that you could sell. Okay, so for instance, if you didn't have these stocks yet, say you just wanted to sell a put and you don't have the stocks to be able to sell a covered call, you could just sell a put for $21 strike price at a 1 week expiration and receive a $63 premium, quite large for just renting out your $2,100 in a week. So yeah, we'll go to the whiteboard and we'll analyze this a little bit. Here we have TSLL. We took it to the whiteboard to do a quick analysis. The risk level I assigned, personally, my own opinion, to this stock is a 9 out of 10. It's pretty risky, but can bring a great reward. So let's just look at these weekly calls that you can sell, and we'll do a quick analysis on the percentage reward you can make in 1 year. So let's start over here. So a 79-cent premium per stock would give you $79 times 52. This is how much you can make in 1 year from only investing $2,129. So that would equal $4,108. And then we'll just divide that by 21.29, giving 1.93. So as you can see, you can have a reward of upwards of well over 150% by running this quite risky stock. Let's quickly look at the put as well. The reward you could have here for selling cash secured puts would be 63 times 52 equals 276. We'll just divide that there by the 2100 it would take to secure that put, and we have 1.56. So again, over 150% in 1 year can be made from running this risky TSLL stock. Here is a well-known stock, NVIDIA. It's a more neutral stock as far as risk goes. It's not without risk, of course, but not near as risky as the double leveraged TSLL. So here we'll look at these options for selling options on NVIDIA. If you were to right now buy this stock at $190.06 per stock, and then sell a covered call at a strike price of $192.50, you could receive a $190 premium for just a week of at a week's expiration. And if you scroll up and like say you're wanting to sell at a higher strike price, you could also receive these premiums in the screen here on the right, which aren't necessarily too bad of a deal either. Now let's take a look at the cash secured put, the premiums on those. So again, the share price is $190.06 per stock. If you were to sell a put, a cash secured put for $190 per stock, you could receive a $245 premium for the $19,000 that you would be basically renting out for 1 week. So that's not a bad return either. Let's go to the whiteboard and do a little bit of analysis on that. Now we're taking a look at NVIDIA. It's our middle risk stock that we're looking at today. Not near as risky as the TSLL. I just gave it a risk 4 out of 10, but not as safe as I would say Walmart is as far as fluctuations in stock price. But let's go ahead and look at the kind of reward you can get for your risk with this stock. So best case scenario, you buy 100 shares here with $19,006, and then you sell the call. So we'll say this is your weekly call, and you go 190 times 52 weeks in a year. That gives us $9,880, and we'll divide that by the share price here, 19,006, and that'll give us 0.52. So we get 52% return, which is not too bad for your amount of risk you're taking on. Pretty good. That beats the average return in the stock market of about 10% a year. So let's go ahead and look at the returns on the puts you can get. If you sold a cash secure put for $19,000, you would receive a premium weekly premium of $245. So let's go ahead and do that math. 245 times 52. That gives us 12,740. And we'll divide that by 19,000, giving us a 67% return. Not a bad return for your risk here. It's not as much as the over 150% a year for TSLL, but this NVIDIA stock is a lot less volatile than TSLL. So, no risk, no reward. You are risking some here and you're gaining some. You're not risking as much as you're not risking with NVIDIA as much as you would TSLL. So it makes sense. Your premiums aren't as much percentage-wise. Our last stock to look at is Walmart. It's perhaps the safest out of the three we've looked at. The largest retailer in America, I believe in the world actually. Walmart is a pretty safe stock, you could say. Let's take a look at those options with selling the covered call. You could own 100 shares at $111.60 a piece, and you could take those and sell a covered call with a strike price of $112 per share for an $80 premium, much less percentage-wise than TSLL, even less than NVIDIA as well. If you scroll up, you can see the premiums drop to close to zero and down to zero pretty quickly, or at least not a huge amount. You go up a little to about selling it for investing over $11,000, and you're trying to sell the strike price for $115, you're only going to receive $10 for that premium there. Of course, the chances of something happening to Walmart stock where there's a huge drop in the share price or anything like that isn't near as large, so your premiums, your reward for your risk won't be so large either, since there's much less risk with a stock like Walmart compared to the double leverage stocks or perhaps a tech or AI stock. Here we have the cash secured puts. If you were to sell a cash secured put for $11,100, which is the $111 per share price right here. So you would receive $55 or 55 cents per share when you would sell that cash secured put. Not a huge premium, but not too bad either if you want to stick with the less risky stocks, which Walmart is. Let's go take this data to the board and do a little bit of analysis with this. Lastly, of our analysis of stocks, we have Walmart, the least risky of the three. I, in my own opinion, assign it a risk level of 2 out of 10. So yeah, let's just jump into it here. So if you were to go ahead and have your 100 shares bought at $111.60 a piece, and you sold that call at a strike price of $112, you would have made a premium of 80 cents a share. So let's go ahead and see what you could get by acting and working in this manner for a year. It would be $80 times 52. These are weekly calls. That equals 4,160. Divide that by the 100 shares of that share price there, which is 11,160. And you have a percentage of 37%. You know, 37% isn't a bad return for a safer stock like this. You're not taking near as much risk as NVIDIA, not even close to as much risk as TSLL. So you're not going to be making like well over 100% returns, but your money is much safer, in my opinion, with Walmart. It is a less volatile stock. So yeah, let's check out what you could get with the put. So there you go. If you sold that put for $111 per stock, you get a 55 cent per stock premium. Let's do 55 times 52 weeks in a year. That would equal for us $2,860. Divide that by the price you would have to put down, the 11,100, and we get over here, we get a percentage of approximately 26% in 1 year. So yeah, this is just an analysis of risk and reward that we've done here, and you know, your risks could be could be the stock dropping. It could be so many different things. It could be the risk of missing out on all these premiums. It may be riskier to buy what would seem like a less volatile stock because you're going to miss out on all those huge premiums from the more volatile stock. So you have to weigh your risks in many different ways, and your rewards in many different ways. But the gist of it is, without risk, there is no reward. If these videos are bringing you any value, please like, please subscribe, comment. I'd like to answer questions if I can. If you want to send any comments or ask any questions, take care and bye for now.